If you have a Medigap plan, you've probably had that moment. You know, the one where the letter arrives telling you your rate is going up. It's frustrating, right? And kind of confusing. Well, the whole point of this explainer is to cut through all that noise, show you exactly why it happens, and, most importantly, what you can do about it.
So you open your mail, you see the news, your premium is going up again. The first thought for so many people is, now what? Am I just stuck with this? Well, the good news is you actually have way more control than you might think. Okay, let's dive right into this.
First things first, we've got to understand why these increases happen to begin with. You know, it's not random, and it's not just your specific policy. It's really a fundamental part of how this kind of insurance works.
And this right here is the most important thing to get straight from the start. Seriously, if an agent ever tells you your rate will never go up, well, they're just not being honest. Rate increases are a totally normal feature of every single Medigap policy from every single company. The trick is understanding what's driving them.
So what's really behind these rate hikes? It pretty much boils down to two main forces. First, there's your age. For the most common types of policies, your rate just kind of ticks up a little bit each year when you have a birthday. But the other driver, the one that affects everybody, is the economy, specifically inflation in healthcare. As medical costs go up across the board, premiums have to follow suit.
And this number really drives that point home. I mean, look at that. U.S. health spending jumped 7.5% in just 1 year, from 2022 to 2023. When the actual cost of care goes up by that much, you can see why insurance premiums have no choice but to adjust.
Okay, so if inflation hits everyone, why not just find the cheapest plan and call it a day? Well, it's because of this critical fact you see here. Medigap plans are standardized by the government. That means the coverage you get from a Plan G is identical. I mean, literally, to the letter, no matter which insurance company is selling it. The benefits do not change.
Which, of course, brings us to the million-dollar question, right? If the benefits are exactly the same, how can one company charge you so much more than another for the very same Plan G? Well, the answer is all about how they structure their prices for the long run.
And to figure that out, we need to pull back the curtain and look at how these premiums actually work. There are really 3 different ways that companies can price their policies. And trust me, understanding which model your plan uses is the secret to knowing how your costs are going to change over time.
First up, you've got attained age. This is by far the most common one you'll see. It works like this. It starts you off with a lower premium when you're younger, but that premium goes up as you get older. Think of it like a staircase. The price climbs one small step every year on your birthday, and that's on top of any bumps from inflation. Next, there's issue age. This model is a little different. It locks in your premium based on how old you were when you first bought the policy. So you're protected from those yearly birthday increases. But, and this is a big but, it doesn't mean your premium is frozen forever. It's still going to go up over time because of that pesky healthcare inflation.
And finally, we have community-rated plans. Now with these, everyone in a specific area pays the same base premium for the same plan. Doesn't matter if they're 65 or 85. This makes it the most stable and predictable of the 3, but it also usually means it starts at a higher price.
So, to put it all together nice and simple, attained age goes up as you get older. Issue age is based on your age when you first sign up, and community rated doesn't look at your age at all. Knowing which one you have is absolutely key.
Okay, now that we've cracked the code on pricing, let's talk about the plans themselves. For most people getting into Medicare these days, the choice really comes down to 2 super popular options, Plan G and Plan N.
So here's the trade-off. With both plans, you have to pay your annual Part B deductible first. Simple enough. But after that, Plan G has 0 copays. Plan N, on the other hand, gives you a lower monthly premium. But in exchange, you might have some small copays, like up to $20 for a doctor's visit. It also doesn't cover something called excess charges, but honestly, those are extremely rare.
So how do you pick one? Well, here is a fantastic rule of thumb from an expert in the field. Basically, if you can save $25 a month or more on the premium by going with Plan N over Plan G, well, that's $300 a year, and the math often works out in your favor. It's just a really simple, powerful way to think about the choice.
All right, you've looked at your rate increase, you've compared your options, so how do you actually make a change and take back control of your costs? This is where it gets really interesting.
Now, here's something a lot of people don't realize. Unlike other parts of Medicare, there isn't a special enrollment period for Medigap. You can literally shop around and apply to switch your plan any day of the year. But there's a catch.
In most states, once you're past your initial enrollment window, you have to answer a bunch of health questions to get approved.
This is where this term, guaranteed issue, becomes your absolute best friend. A guaranteed issue right is like a golden ticket. It means you can buy a policy without going through medical underwriting. An insurance company cannot deny you coverage or charge you more just because of your health history.
The big question then is, how do you get one of these incredible guaranteed issue rights? Is there some secret way to shop around freely, even if you have a few health conditions? For some people, yes, there is.
And this right here is the solution that exists in a handful of states. It's called the birthday rule. It's the special annual window right around your birthday where you get a guaranteed issue right to switch your plan. It's a real game changer.
And using it is pretty straightforward. First, you just have to check if your state is one of the few that actually has one. Second, you got to know your exact window. Like in California, it's the 60 days after your birthday. During that window, you can switch to any plan with the same or fewer benefits from any company you want. No health questions asked.
Wow. Okay, we have covered a lot of ground here. So let's just take a second and boil it all down to the most important things you should walk away with.
Okay, here are the big 4 takeaways. Number 1, rate hikes are normal, so don't panic. 2, the pricing model is what tells you how your rate will increase over time. 3, remember, a Plan G is a Plan G. The benefits are the same everywhere, so you can and should shop for a better price. And 4, you always have options, and in some states, that birthday rule is your annual golden ticket to make a switch.
And that really leaves us with just one final question for you to think about. Now that you know how the whole system works, from the pricing models to your right to switch, is it time to take a fresh look at your own policy? Is it still giving you the best possible value for your money?